Welcome to another episode of Mish Talk TV. It is my pleasure to have Keith Weiner back on the show. He is at Monetary Metals, the CEO. He's going to explain how we get interest on gold. Keith, welcome to the show.
Hey, Mish, thanks for having me back. It's a pleasure.
Oh, I've been looking forward to this discussion. One of the complaints over the years that I've heard on and on and on, and actually it's Warren Buffett's complaint too, he doesn't like gold and silver because they don't have any yield. Well, you've kind of changed that. So tell me a little bit about Monetary Metals and how one would go about getting interest on metals.
So our whole company is based on the idea of paying a fixed income on gold and silver. So making the Warren Buffett objection, we wrote an open letter that said, Dear Mr. Buffett, what you said was true, but no longer. And in order to pay yield on something, you have to put it into productive use in the real economy. You can't have a self-referential, here, let's keep the gold within a closed loop and somehow we spin it faster and faster and generate more and more yield. That doesn't really work. That becomes a Ponzi scheme of some sort. You have to put it into productive use. So we have two programs broadly. We lease gold to companies that use it as either inventory or work in progress. So picture refiners, recyclers, jewelry manufacturers, mints, bullion dealers. They all have either inventory or work in progress that's gold, and they need to finance that, and they need to offload the price risk. And then the lending program, which is a securities offering, so it's restricted to accredited investors only under SEC rules, is for companies that have a gold income. So picture mining companies. They don't have gold inventory, but they pull gold out of the ground. So they need, let's say, $10 million to buy and build a plant to process the ore. They borrow that as 5,000 ounces of gold rather than as $10 million. And they can control what they repay by knowing how much gold they pull out of the ground without having to worry about the price risk. Both of these programs have the proposition to the investors, put your gold to work. So instead of paying to store it in a vault, instead you're getting paid interest on the leases between 2 and 5% per annum, gold on gold. So 100 ounces at 3% means at the end of the year you get back 103 ounces. And on the bonds, between 5 and 20%, depending on the.
Give me an example of, let's start with bonds. People are going to look at this and say, 20% interest. Well, that was your last offering, right? How did that work? How did that turn out? Who was it with? Why was the yield so high?
19%. The borrower is a company called Akobo Minerals, AKOBO, which is a public company that trades on the Oslo Exchange in Norway. But the mine asset is in Ethiopia. So you can talk about how great the mine asset is and how rich the deposit is and how low the cost per ounce and all those things are, which is all true. And it's Africa. And so the interest rate is actually not 20, but 19% to the investor because of the Africa risk. I mean, you can't wave your hand and say, yeah, no, it's fine. I mean, it is what it is. So I think it was Jim Grant who said, there's no such thing as a wrongful risk. There's only risk that's not adequately compensated. So the key is to set the interest rate to compensate for the risk. And
so essentially, this company needed money, either for more equipment, or to build the mine, or to drill holes, or any of these reasons. A company might want money. And you're pledging gold, you get paid back in gold, is that right? And depending on the company risk and the nation risk here, being in Africa, that's going to determine the interest rate. Did I summarize that correctly, Keith?
Exception, which is we wouldn't lend for drilling holes and other exploration and development activities. We want to lend specifically to either increase production or get into production. So in this particular case, They had to dig the decline to, it's an underground mine. They had to dig the decline, which was a bunch of waste material you have to get through. They had to do some site work to put in a concrete pad and a little building for the processing plant, and they had to buy and set up and dial in the actual plant that processes the ore and turns it into.
Okay, so this isn't speculation about holes. These are, proven reserves that a company, for whatever reason, needs to raise money to actually produce that gold. Is that right now?
The gold's in the ground. We send a geologist that we hire to help us do the due diligence. We went on site with him for a couple of days, looked at everything, and said, "Yeah, we really believe there's really gold in the ground," which is obviously the first problem. Secondly, do you have a decent mine plan? Thirdly, do you understand the metallurgy? Do you have the right equipment that's going to actually process that ore? Some ore is, very difficult to process. Some ore is pretty simple. Did you get all that right? So we did our due diligence. Said, yeah, we believe you got it right. And so we lent them, in this particular case, it was 5,000 ounces of gold. And that's, investor gold that people wanted to participate in this deal.
And this is open to accredited investors only, this type of investment? And what about a gold lease? Give me an example well, first off, explain what it is and tell us why someone would want to participate in it.
So gold lease is where, let's take the example of, we have a small gold refiner in Andorra called Lefebvre. I'm not sure if I'm pronouncing that right. It's a Catalonian, they speak Catalonian there. So it's not French nor Spanish. It's some bastardized in between. So a refiner is always bringing in, doré, the raw gold, and it takes them X amount of time to process it, and then they turn it into bullion grade, metal, and then they sell it on to the market. So every day they're buying, fresh doré, and every day they're selling finished product, but there's always a certain amount of gold in the process or in the system, as it were, and that needs to be financed. So that's where a lease is appropriate. A lease, so it's kind of ironic that, we can argue that gold is money, or I certainly do, but it isn't regulated that way. It's regulated as tangible property. So a lease is essentially a rental agreement, no different than, if I'm done with this thing and I want to rent it to somebody, that's not a securities transaction. I just rent it. It's okay. You're going to pay, $10 a month to rent the phone. So you can rent your gold out, and that's what a lease is. So it's not a securities transaction, and therefore not restricted to accredited investors.
So the lease rates would tend to have less risk than the bond. Is that correct? What's the range of interest rates of yield on the typical lease?
So 2 to 5% is kind of range. We have one that's just coming out next week that is going to be at the 5% end. That's to a company in Turkey, and that's part of the explanation for the slightly higher rate. But what makes a lease is that the gold always has to be physically there. We go to great lengths to determine and redetermine every day that the metal is actually physically there where it's supposed to be. It is not on balance sheet of the lessee. It is not a credit. It is not their asset. Not available if they declare bankruptcy. Is not available to satisfy their creditors. It's like if you lease a car from Ford, and then you declare bankruptcy, your creditors get to fight over your assets, but Ford simply repossesses the car. And so it's a similar situation with a lease, and so it takes out a lot of that risk. Whereas if you lend to anybody that is an on-balance sheet asset, you are subject to credit risk. And if you're lending to a mine, there's 1,000,001 ways that honest people can lose money in a gold mine. I mean, you can make a mistake in your mine engineering and your shaft collapses. You can make a mistake and the ore isn't as rich as you thought. You can make a mistake and the metallurgy is a little bit different and you don't quite have the right plant for it. You can have a labor strike. obviously in Africa, all kinds of weird things can happen, like insurgencies and revolutions and government seizures and capital controls and all those kinds of things that in a lease, um, either just simply don't exist as risks or are a lot lower. Um, and so the risks are completely different between the two, um, and reflected, I think, in the interest.
Tell me a little bit about your latest offering. When does it start? How much you're looking to raise? The yield? For how long? Um, those kind of things, Keith.
Leases are 1 year or less, because if you do a lease that's more than a year, it becomes a capital lease, and neither the lessors nor the lessee want that treatment. That becomes adverse from an accounting and regulatory perspective. So it's a 1 year maturity. It's 5% interest. It is a bullion trader that's always importing LBMA accredited bars from generally from Switzerland, and then they're selling it on the Istanbul Borsa in Turkey, and doing that to make a spread. Um, Interest rate's 5%. Maturity is 1 year, um, and we've done a variety of things to understand Turkish law and make sure that what we've done is compatible, with their law.
What does one need to do to partake in this opportunity? Obviously, open an account with you. Is it, sending gold? Is it sending dollars? I think I know the answer to this, but some of the listening audience might not know the answers to these.
Account at Monetary Metals. The way these things work is you have metal on account. It is an opt-out program, so we send you the slide deck that says here's the deal, here's what it looks like, here's who the lessee is, here's the interest rate and all the other terms, and then you have some time to look at it and either opt out or don't. So to actually fund the account, we envisioned, this is one of those things where your business plan is one thing and then you find out something else when you engage with the market. This is the entrepreneurial challenge in a nutshell. We said, we don't want to try to sell people on why they should own gold. If they haven't made that decision by now, there's no words that we possess that can make people change their mind. So let's focus on people who already have gold, and let's, allow physical, people can either hand carry it to one of our depository partners, or they can, we give them a shipping label and they can send it by FedEx, which is insured.
Keith, can they simply deposit money and have you buy gold at the current rate? Does that work?
What happened is the vast majority of our customers would rather send us a wire or an ACH and then have us buy the gold.
Okay, so they send you a wire for $1,000. You receive the wire. You immediately buy gold, and that's what gets leased out, correct? And then they get paid. They get paid back. Their account now actually physically holds gold, and the interest they receive is actually paid back in gold. So other than default, the risk here is the price of gold itself. This would appeal to someone who wants to own gold and yet sees an opportunity to get interest on gold. Does that pretty much sum it up?
For the people that haven't decided to own gold, if they think that the price risk is too much, I totally get that. But in a way, they're going all in on the credit of the full faith and credit of the United States, and they're going all in on whatever degree of debasement that the Fed has planned for the next.
Who sets the interest rate? Who sets the yield on these?
It's effectively a market, right? So we're always talking to both sides. We're talking to the lessees, and they essentially have a bid on the interest rate. That is, they want to pay no more than X, and are happy to get it cheaper. And that's based on a calculus of looking at the business and what the opportunity is. And there's a marginal walking away point where they don't make any money on their business if the interest rate goes above a certain amount. So that's the bid. The lessors, whom we're also talking to frequently, are making an offer. So an offer, you're happy to get that price or higher. And It's our job to understand, what each side is saying and where the stack of bids are and where the stack of offers are. It's our job to clear as much metal as we can. We can't make somebody. This is the interesting thing about gold and what makes it so different from dollars. You can't make somebody lend the gold or lease the gold. If you have gold and you're like, nah, my magic number is 4% or whatever it is, you can't argue with that. It is what it is. So you either bring that person 4% or better deals, or that person's not a participant in the market. Same thing, you got a business that says, look, we're not profitable unless we can lease at 3% or cheaper. So in that case, that investor wouldn't be a fit for that business. So hopefully the spread is the other way around, where the investors are willing to uh, do it a little bit cheaper than what the business wants, and we can make a little spread in the middle.
How long has Monetary Metals been doing this, offering gold bonds, gold leases? So your first lease was in 2015. And how many leases, how many offerings have you done? What, 8 years? How many have you ever had a default, Keith? That's that's pretty impressive, I think. The what else can I ask here? What do you have anything else to say here on this, and maybe a little bit more on the latest offering on Turkey? Why does it look good to you?
You've spoken to about the deal. Um, that deal is ultimately going to expand to become a very large lease. This company has a lot of capacity. We're starting them, smaller for a variety of reasons, and then it will grow, um, as the gold comes in, and it will grow as that company's demand increases. And it's interesting. I think I've said this before on the air. So, as an American who travels a lot, I'm right now in London. I'm not even in the U.S. As I say this, I think Americans understand gold the least of all the cultures in the world. So in Turkey, I can't validate this with my own two eyes and ears, but I've been told everybody in Turkey would have at least 10 grams of gold. There's no way you could possibly say that every American would have some gold, because 99% of us don't have any and don't want to have any. I had a chance to go to the Grand Bazaar in Istanbul, and this thing has been around probably since Byzantium times. I don't know how old it is. And there's all kinds of different stalls of all these different merchants, and they're selling Turkish delight and spices and saffron and carpets and whatever. And increasingly, there's more and more gold stalls that just sell gold. The people are very obsessed with gold. First of all, traditionally, they've always loved it and valued it. They're different from Americans in that respect. And the Turkish lira has been on such a horrible free fall that everybody there gets it. They realize their currency is, in slow motion collapse. And so they seek to buy gold to get out of that. And then that creates a huge opportunity for the bullion dealers there, and everybody involved in that trade, from the importers to the market makers. The bullion trade is booming there, and so that's what we're helping finance, is the Turkish people to get gold to protect themselves from the ravages of inflation. Very simple story, very old story, and unfortunately, mankind doesn't seem to learn from repeating the same stupid policies, over and over. Um,
What
very,
percentage of the deals, Keith, have you personally invested in? Is there any you missed?
um, I think I've been in all of them. In one or two cases, there's been investors that have come in late and said, "Look, I really want an allocation to this deal," and I've let go of my allocation to sort of accommodate somebody that was a squeaky wheel. But I put
Well, Keith, I certainly wish you the best of success. I hope my listening audience takes at least a good look at this, at what you're offering and why. You've certainly attacked the argument that gold yields nothing here because you figured out a way where it can. You've been doing this since 2015, if I have that correct. And one final thing I need to say is nothing that either I say or Keith says should be construed as financial advice. There's risks to everything. Actually, there's risk to doing nothing as well. So with that, Keith, I'm going to let you get in the final word. Anything else that you want to say that perhaps I didn't ask or that we need to go over?
I think a lot of your listeners would probably appreciate this. Some businesses, I mean, obviously every business trying to make money, some businesses have a why. Why are we doing this? When you think about companies like Patagonia or Whole Foods or Apple Computer for that matter, that have a why embedded in what they, everything that they do. It's not tacked on at the end, buy a McDonald's, thing and we'll donate a penny to charity kind of thing. And our why is to bring back the use of gold as money and get it into everyday circulation. And our belief is that by financing productive things and generating a yield for people that have gold, that's how we can bring about a return to the gold standard. And that's why we're doing what we're doing.
Gold as money. Historically, gold has always been money. It's only by government dictate that fiat is now money. Some of us still believe that gold is money and would be in a free market. Whether or not we're ever going to have another free market in money remains to be seen. But meanwhile, we have an opportunity now for those who like gold to participate in earning yield on gold. And please check out, I will have a link on my blog. I'm going to post this video within a blog, and I will have a link with how you can get together with Keith Weiner if you're interested in monetary metals, what he's doing, and how you earn interest on gold. With that, Keith, thanks, and thanks to our producer, Bob. It's been a great session, and I look forward to having Keith on again. Thanks.